This week on The Roth Guy, we take some listener questions, so let's dive in and see if we can help out.
Flying high above the metropolis, it's The Roth Guy with holistic wealth advisor Jude Wilson.
Hey everybody, welcome into The Roth Guy. Back here with Jude Wilson to talk investing, finance, and retirement. And Jude, pretty simple this week. Got a couple listener questions. Thought it'd be good to just kind of pop those up on the screen and dive in and let you break these things down for folks since you are the Roth Guy. How you doing? You doing all right?
Hey, I'm doing great. And these are always my favorite episodes because I love to hear what people are asking and what's on their mind.
All right, well, let's get into it. So pretty simple. What's the 5-year rule? People keep asking about that. They say, I hear a lot about that. I don't understand it. So what is it? Give us a breakdown for that.
Yeah, in the actual legislation of the Roth account, there's a little known provision called the 5-year rule. And basically what it means is you must wait at least 5 years after your first Roth contribution or conversion and or be age 59 and a half to withdraw earnings tax-free. So let's not get confused here. You can always pull out the money that you put into a Roth because you've already paid taxes on that. That's after tax dollars.
Okay.
But any money that you've earned on that contribution has to wait at least 5 years or 59 and a half. So what we tell clients is if you're at all interested in a Roth, open up one as soon as possible so you can start that clock ticking in that 5-year rule.
Yeah. I mean, basically, you want to just kind of get like you said, the clock moving, right? So if you open one up, even if you do a small amount or whatever, and then you're doing maybe Rothing over time and you're converting more money from your traditional IRA, at least you've got it rocking and rolling and you kind of get that 5-year window or, time period moving. So pretty simple. I guess there's technically two. They technically break it into two rules, right? There's the contributions and then there's the earnings part of the 5-year. But it really just kind of all falls together in that same piece. So pretty simple, but if you have those questions, you need some help about how to set one up or how to do conversions or anything like that, obviously reach out to Jude and the team with links below. All right. The next question we had that somebody had sent in that says, what about if you make too much to contribute to the Roth IRA? A lot of people out there do, right? So they didn't make a lot of changes in the Secure Act 2.0 the last time they did some stuff there. But there are some other things that people can do. So how does that work?
Well, what most people think of when they hear Roth, they think of a Roth IRA. They don't know that the Roth has a cousin. It's the Roth 401k. And
True.
more and more companies are offering Roth 401ks as option in the traditional 401k. So in a Roth IRA, you're absolutely right. There are income limits. And if you make too much money, you cannot contribute to a Roth. Now, in its cousin, though, in a Roth 401k, there are no income limits. So you could be Bill Gates and still contribute to a Roth 401k.
Right.
And
They
so,
kind of married the two, right? And that was something it's only been around since I think like 2006 maybe. So it's not been around long. So that's a great option, but you got to check with your workplace employer on that.
absolutely, absolutely. And it's becoming more and more popular. I remember a few years ago, I rarely ever saw a Roth 401k. And it's not a separate 401k, it's an additional option inside your current 401k to
Yeah.
make those after tax dollars a contribution to the Roth portion.
Okay.
And all of the same benefits with the regular Roth IRA pertain to the Roth 401k.
All right, that's option one, right? So
Right.
just to see if that's available. Now, if you've been contributing to your traditional 401 and you make too much, there's something called the backdoor Roth, right? Which sounds shady, but it's totally legal. So what's the deal there?
Yeah, and in fact, there's been some talk about trying to regulate this, but for a while it's still in existence. If you're contributing to a 401k, you can contribute to that with pre-tax dollars, obviously, and then convert that money over to a Roth because there's no income limit on the amount of money you convert. So imagine this: you contributed $50,000 to your 401k on a pre-tax basis, and then you convert that money over to a Roth. Now you've moved money from always taxable in the future to never taxable. So it's almost like a two-step dance. Instead of going directly, if you don't have a Roth 401k, it's a
Hmm.
two-step dance to get the same thing accomplished.
All right. So does that help with the income limits and the contribution limits then?
Oh, absolutely. But like we tell everybody on every episode, there are nuances, and you should absolutely, before doing anything willy nilly, speak to a tax professional about doing the backdoor Roth and what nuances may affect you.
Okay. I'm going to throw one bonus one at you that you might not have been expecting, but I think you
All
can
right.
handle it. It's pretty
All
easy.
right.
We get this one quite often too that'll pop up, and it says, should I just convert my entire IRA to a Roth at once? And we've been seeing that earlier half of this year because we didn't know if they were going to extend the TCJA. We've
Right.
talked about this the last couple of weeks. They have now since extended that. So Rothing over time is back on the table as an option, but is it a good idea to convert it all at one time?
Well, I've got a three-word answer for that. Do the math.
Okay.
'Cause you can rip the Band-Aid off all at once. And if you are young enough and you have a long life expectancy, that may not be a bad option. It's
And you
going to
need
be
that,
painful.
you need some of this, right? To do.
Yes, yes, it's going to be painful because you're going to
Yeah.
pay taxes as income on all of that money. So if you have a $500,000 IRA and you make $100,000 a year, well, now guess what? You're going to pay taxes on all of that accumulation,
Yeah.
minus whatever deductions you have. Just standard to understand that that money is going to be taxed. Now, what we do when we're helping clients is we look to see at what point in your life do you cross that where the benefit outweighs the taxes that you paid. And so for most people, if you have a long life and if you're young enough, yeah, at some point in the future, that really would make mathematical sense. But again, you have to do the math. And typically what we see people doing is Rothing over time. And we've used that term on several occasions in other podcasts, is doing a little bit of a Roth up to a certain tax bracket where you can afford to pay the taxes and it doesn't kick you into the next highest tax bracket where you're paying even more taxes on the income.
Yeah. Yeah. You're maximizing those steps. So if you need some
Exactly.
help with that, and you probably do, make sure you don't just do this on your own. Reach out to qualified professionals like Jude and his team. You can find links in the show description below to visit his main website or thetaxbomb.com, where you could go take the tax bomb calculator there and see how that might affect you, right? So we did an episode a couple weeks back. You can check that out if you'd like as well, but just go do it for yourself. Fill out the information on the tax bomb calculator. You'll get a little email report kind of showing you the breakdown. And then if you want further help understanding how that works, then reach out, schedule some time with Jude and his team, and get on to the calendar. We'll see you next time here on The Roth Guy. Don't forget to subscribe to us on Apple, Spotify, and of course, YouTube. Thumbs up, subscribe, and notification bell supports the channel, helps us out, and lets us know that we're helping folks out there. So we'll see you next time, Jude. Thanks for hanging out, my friend, and tune in for more Roth Guy with Jude Wilson.
Rock and roll. Thank you, my friend.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Centrus Financial Strategies and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Centrus Financial Strategies are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form 80V from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.